I'm Howie Lim. This is Money Hacks by the Business Times.
So despite the high interest rate environment, despite the strength in the equity market, we continue to see very strong demand for gold in 2024.
It is already one of the highest. And if I compare with the gold market by itself, gold has made 40 year-end high in this year and is the second best in the last 50 years.
Gold prices rose sharply in 2024, and some experts say could reach $3,000 by the third quarter of 2025. But there are risks involved. Its future direction may be swayed by the pace of interest rate cuts and trade tariffs. So should we stock up on this safe haven asset in 2025? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. Joining us today is Albert Cheng, CEO of the Singapore Bullion Market Association, and Robin Tsui, APAC Gold Strategist and SPDR Gold Sales Specialist at Street Global Advisors SPDR, in interviews we did before the end of 2024.
So if we look at the spot price at the moment, obviously it has declined a bit since Trump won the election back in November. But if we look at the overall price performance, 2024 by about 26%. If the price level stays until the end of 2024, gold price will be up 26%, will be the best performing year since 2010. So despite the high interest rate environment, despite the strength in the equity market, we continue to see very strong demand for gold in 2024. We always advise clients to hold about 5 to 10% allocation in gold. So typically, if a client hold a 60-40 portfolio, so 60% of equities, 40% of fixed income, we do a lot of research surrounding how much gold to hold. And usually 5% is a good benchmark to have. But going forward, we do realize clients do hold a lot more asset classes.
Physically backed gold exchange traded funds, or ETFs, also registered a net inflow of $3.4 billion in 2024, which is nothing to be sneezed at. And in 2024, savvy investors are turning their attention to gold as central banks worldwide, led by China, ramp up their gold reserves. Here's Albert Cheng, CEO of SBMA, who feels a gold history lesson is warranted.
The modern gold market started only 50-something years ago when President Nixon closed the gold window and gold become commoditized and not in the hands of the central bank or in the wealthy or in the imperial court. Gold now can be owned by any people in the world, provided the legislation allow them to hold gold without tax. Like Singapore, when we are a free port, that gold can come in and exported and traded in Singapore. Unlike some country in Asia, there are still some restriction either by import duty or there are some tax related to investment gold. I think when I entered into the career about 30 years ago, particularly the Swiss banker were advocating 3 to 5% of the asset class into gold. But over the year, I have seen investor or the asset allocator, asset manager are trying to tell people that you might want to add a little bit more. And some portfolio may be over 10% or even 15%. And if they have done so this year, I think they are benefited from it.
Gold's advance was fueled by US rate cuts, geopolitical risks, and purchases by central banks. We get that. Has it affected investors' allocation into gold? Here's Robin from Street Global Advisors.
So the trend going forward for clients that we're speaking to is to hold more alternatives, including gold, real estate, and even Bitcoin. Bitcoin's been doing quite well in 2024. But based on analysis, the results are the same because gold historically has very low correlations to stocks and bonds and also very low correlations to other alternatives. So having a 5% allocation, it's very effective for investors to have that hedge against market volatility and uncertainty. And the clients we're speaking to, some of them don't hold 5%, some of them hold maybe 1 to 2%. But the conversations that we're having 2024 in Asia, including Singapore, is that clients do want to hold more gold in the future. And that's driven by the increase in tensions around the world and also the unexpected policies that Trump may push out going forward. Based on our discussions and some of the surveys we've done 2024 is that we do believe that clients in Asia will tend to increase their allocation to gold going forward.
Since gold had such a stellar 2024 and by all accounts a stellar decade, won't it become price prohibitive for some to get into now?
Yes, that's a great question as well. We recently released our latest outlook for 2025. And we still believe there's more room to run. So in our base case scenario, gold price will trade somewhere between 2,600 US per ounce and 2,900 US per ounce. And based on that scenario, we expect everything to be in line with expectation in terms of the rate cuts. So we do expect 3 rate cuts next year. Rate cut cycle is usually beneficial for gold prices because it actually reduces the opportunity cost of holding gold. So 3 rate cuts will benefit gold price in 2025. And another core reason we believe gold price will do well, it's from central bank demand. Central bank demand has been quite strong in the last 3 years. Central banks are actually buying gold at a record pace. So 2024, we do expect central banks to accumulate close to about 1,000 tons of gold, which is close to the record level that we saw 2 years ago. It's a lot of reason for central banks to buy gold.
Still to come, how should we position ourselves with regard to gold in 2025? And will its current high prices affect demand for the upcoming Lunar New Year? More with Albert Cheng from SBMA and Robin Tsui from Street Global Advisors in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. We've been talking about the money of kings, all that glitters and that universally desired precious metal that is the ultimate store of wealth, gold. It looks like for 2025, investors are focused on uncertainty around US monetary policy, potential frictions from Trump's presidency, and China's efforts to revive growth. Robin Tsui from State Street agrees.
If you come down to some of the major buyers, they're all emerging market central banks. So China, India, Poland, Turkey. Historically, they have very low exposure to gold holdings. So the theme of central banks moving away from some of the US Treasury holdings to gold, we can actually see it in the last couple of years. Especially the PBOC, they bought gold. They stopped for 8 months, but the PBOC in China, they've been ramping up the gold holdings. They've been selling out their US Treasury because they probably think the geopolitical tensions will remain quite high in the future, especially with the Trump administrations, what they can do to China in terms of the tariffs and also the policy that can push out might be not favorable for China and other central banks that we study as well. So the key reason why central banks has been ramping up is to diversify. Like a normal investor, they do need gold as a way to diversify their holdings in other currencies because most of the central banks, they hold quite a large amount of substantial in US holdings. And gold as a currency, it does not depreciate. Gold is well liked by central banks around the world, but in the last 10 years, the emerging market central banks has been ramping up their exposure.
And what's 2025 going to look like for gold? What about headwinds or tailwinds, and how should investors position themselves?
It is definitely the number one reason why investors hold gold in general. We speak to clients ranging from family offices, robo-advisors, asset owners, asset managers. The number one core reason why they hold gold is that it has very low correlations. And some of the work we do for them is look at how gold can actually interact with their allocations in traditional asset class and alternatives. So definitely the number one reason will be the safe haven status of gold, and then also how gold can actually improve the overall risk-adjusted return of the portfolio. gold does not pay interest and dividend. But if you look at the price performance in the last 2 years, it's been quite substantial, up 13% last year and now 26%, 2024. So overall, despite the non-yielding property of gold, the capital appreciation potential has been quite substantial since 2023.
And as the Lunar New Year approaches, will there still be a demand for gold at these crazy prices? Here's Albert Cheng from SBMA.
Traditionally, yes. It's a factor of people feel rich and people feel they have done a good year and they want to keep some money behind for future year. Particularly in Southeast Asia, in our agricultural economy like Indonesia and Vietnam and Thailand, the farmers, after a good harvest, after they have accumulated some money, they will buy some gold. So yes, Chinese New Year is always a good season for gold. However, because price of gold has increased by so much this year, a lot of them will feel that I may not be able to buy that many, but it doesn't deter them to buy. So I will see that the volume of gold demand in jewelry will reduce, but the monetary value of money spent in gold jewelry will remain. But on the other part of the gold function, which is gold as an investment, as a store of wealth, I think that part will continue to perform well. China is a very important factor in this area because we all know that China economy has a lot of headwind and the property market is not performing well. In fact, if people now have money, they want to save it for future use. I see quite a number of them actually buying gold as a way to preserve their wealth and preserve their buying power as RMB is depreciating. And there are not many investment opportunity in China. We see gold is a good option for them.
Usually that's a seasonality for Chinese New Year and also Indian weddings. In particular, the jewelry side is dominated by the Indians and Chinese. They represent about 50% of the jewelry demand globally. We have been studying the Chinese demand in the last few months. Not surprising to us, the demand has been getting slower despite the Chinese New Year in a couple of weeks. The main reason has been that because gold price has been trading at record highs, some of the jewelry demand in China has been weaker compared to the last few years. And also, I think because China, the PBOC has been pushing out policies that's been favoring the equity market and also the property market in China. So we've been seeing a lot more probably interest in those asset class rather than gold. So one of the indicators that we look at is the premium of the Chinese gold price in China versus the international gold price. In the first half, the premium was over 5%. So Chinese investors are looking to pay a 5% more over the international spot price to get access to gold. But in the last few months, we have seen the premium has been close to zero, which means that to us that Chinese investors have not been having that stronger interest in gold compared to in the first half of 2024. Jewelry has been declining, but we are seeing continued strong demand from an investment side. So if we're looking at the ETF flows into those China domicile gold ETFs that's listing in Shanghai and Shenzhen, it remains to be quite strong. So we are seeing a weakness in jewelry in China, but we're seeing a pickup from the investment side because they probably expect the Trump policy might not be very favorable for investment in terms of equities or even the currency, because you're seeing the CNY has been weakening since Trump won his term. So that could potentially push up investment demand in gold in China.
A big thank you to Robin Tsui, APAC Gold Strategist and SPDR Gold Sales Specialist, State Street Global Advisors SPDR, and Albert Cheng, CEO of the Singapore Bullion Market Association. And don't forget to send us an email if you have feedback or an episode idea, btpodcasts@sph.com.sg. I'm Howie Lim, wishing you 金蛇迎春，万事顺心. The golden snake greets spring. May everything go smoothly for you. Happy Lunar New Year. This has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.